Hello, my name is Eric Lund, and I'm a senior economist at the Conference Board, and welcome to the September episode of Economy Watch. This month, we will be talking about the impact of COVID-19 on the Canadian and the British economies. Specifically, we're looking to tackle what COVID-19 has looked like in the UK and Canada, and how it's impacted business operations in the region. How leaders in these countries have responded to the pandemic, how the economies in these two countries have been impacted, and what kind of a recovery is likely, and then finally, how do Canada and the UK fit into the global economy, and what are the risks to business leaders as a function of that. As is always the case, we offer CPE credits to our audience, so make sure to tune in to the entire webcast. There are also 3 pop-ups that will come up over the course of the next 60 minutes, and you'll need to enter your information into the window at the bottom of your screen. We're very fortunate today to have several guests on the webcast. I'm joined by my colleague, Ottoman Ozildirim, who is Senior Director for Economic Research here at the Conference Board. Welcome, Ottoman.
Good morning, Eric.
And joining us from TCB Canada, our sister organization to the north, is Pedro Antunes. He's the chief economist at that organization. Welcome, Pedro.
Well, thank you. Thanks for having me. It's a pleasure.
And certainly last but not least, we have Barry Naisbitt, the Associate Research Director for Global Macroeconomics in the UK with the National Institute of Economic and Social Research. Welcome, Barry.
Good afternoon from London, and thanks for the invite.
Wonderful to have you. Thank you for joining. So as is the case with every episode of Economy Watch, first we'll talk a little bit about the Conference Board's most recent economic forecast for the U.S. And the global economy, and then we'll dive into the details regarding the special topic, which is, of course, Canada and the UK. So here in the U.S. presently, we're seeing some improvements in some of the COVID-19 numbers that are rolling out in recent weeks. Of course, earlier in the summer, there was a lot of concern about a relatively large uptick in the number of new cases, but that seems to be on the decline, which is very welcome news. That having been said, it really varies from state to state, and that, of course, has an impact on different parts of the U.S. economy. We've actually been tracking this at the Conference Board. In the chart that's currently on your screen, there are 2 sort of metrics that we are trying to highlight here. The red dots represent the positivity rates for each state, and states are listed on the bottom. So the higher the positivity rate, the higher number or the higher share of positive results per COVID-19 test that's given. The WHO recommends that a certain geography resist reopening its economy until the positivity rate has fallen below 5% for 14 consecutive days. So what we've done here is we've ranked them from the lowest positivity rate to the highest positivity rate. The green states in the green section represent those states that have below that 5% threshold. The yellow represent states that have between 5 and 10%, and then the ones in red have a positivity of 10% or higher, twice the WHO recommendation. What we've also done is we've looked at the amount of output per state or gross state product to get an idea of what the aggregate exposure for the U.S. economy looks like. And as you can see, about 23% of the U.S. economy is above that 10% threshold. And another 35% is between 5 and 10%. So there's still a fair amount of risk to the overall U.S. economy. That having been said, we published this same chart last month, and there has been a lot of progress. The size of the green area, which is now about 45% or so of the U.S. economy, was much smaller. So as the virus hopefully trends lower over the coming months, we're expecting to see a smaller and smaller share of the U.S. economy being exposed to this kind of risk. Even though we have had this uptick in the number of new cases of the virus over the last few months, which is on the decline, as I mentioned, we had expected that a lot of the macro data that we track here at the Conference Board would start to worsen as a function of that. And certainly, there are pockets of the economy that aren't performing maybe as well as we'd like them to. But broadly, we are seeing maybe a slightly stronger recovery than we had initially thought over the summer. And this is reflected in some of the indicators that you currently see on your screen. On the top left, we have initial unemployment claims. These are numbers that are published on a weekly basis, and we're seeing those continuing to drop. Indeed, during the job report that came out last week, we saw the official unemployment rate for the U.S. fall below 10% to, I believe it was about 8.5% or so. So there is some progress that's being made in terms of the job market and the number of people who are currently out of work. That having been said, we're still at extremely high levels, and there's a lot of work to be done, that remains to be done. On the bottom left, we have a snapshot of consumer confidence versus CEO confidence. Recently, we have seen the CEO confidence numbers in the U.S. Improve a little bit, but there's been a pretty marked deterioration in that consumer confidence number. And this, of course, we believe is in part related to the high level of unemployment, but also, of course, just the sheer amount of uncertainty in the U.S. with respect to cases, with respect to school reopening, companies opening their doors again. So that's really a key metric that we're watching. Given the very large share that the consumer spending has on the U.S. economy, what we're seeing in sort of the labor market in terms of unemployment, in terms of wages, in terms of consumer confidence, these are all pretty critical aspects in terms of determining what the recovery looks like. That having been said, as I mentioned, there are some parts of the economy that appear to be doing recovering relatively well. In the top right, we have a chart on home builder sentiment. We've been reading a lot of articles, of course, about people moving out of certain urban areas and into the suburbs. This has inspired a lot of new construction in the residential sector. And so as a function of that, the home builders and residential construction activity, things like that, appear to be doing relatively well. Indeed, the sentiment numbers are the highest on record at the moment. Also, in terms of business investment, it has been a bit of a mixed bag in terms of what companies are spending on. But within equipment, we're seeing a pretty healthy rebound as well. What we see down on the bottom right are some data that examine new orders and new shipments of capital goods, excluding defense and aircraft. So we're seeing a positive trend there as well. In terms of business structures, however, things appear to be quite weak still, and there's still some progress to be made in terms of intellectual property and things like that. So a bit of a mixed bag in terms of the economy overall, but there are certainly some green shoots that we're seeing in certain sectors. We're going to turn now to the audience. We'd like to engage you and try to see what your perspective is on certain topics. So we can bring up that poll question quickly. U.S. business investment has fallen dramatically since the pandemic began, as we were just discussing. In terms of your individual company, when do you believe capital expenditure may return to pre-crisis levels? The possible answers are we're already spending what we did prior to COVID-19. Number two, the fourth quarter of this year. Number three, the first half of 2021, the second half of 2021, 2022, or it may be years until that level is hit again. There's also a no vote option, but I encourage you not to use it. We'd like to hear your perspective. So let's go ahead and maybe lock that poll up and we can talk about the results. So it looks like about a third of you are saying that the second half of next year is your current expectation. A few more, it's a bit lopsided, the curve, into 2022. 18% for the first half of next year. And then we have about 10% of you saying right now, and a little more than that saying it may be years. What do you think about this, Alderman? Does this meet your expectations in terms of what we're expecting business investment to do?
Yeah, so it doesn't look too different from the expectations that we're working with, and it seems largely in line with what we found out in the middle of the year when we asked C-suite executives in our survey of member companies and more around the country. About 1,300 C-suite executives responded, and the majority of them are really looking at their own organizations recovering in the second half of next year and even longer. So I think that's what we're seeing, a reflection of that. As business leaders see their businesses recover, they'll be starting to think more about those capital expenditure plans, yeah, this seems pretty much in line with that.
What about Pedro? What do you think about this in terms of what you're seeing in Canada? What are businesses doing with respect to investment?
Well, I have to say that, in Canada, we've been struggling with investment for a number of years now, and we can get into some of the reasons behind that. But we have seen business confidence pick up a little bit, but we really haven't seen investment coming back yet. So, whereas you've seen green shoots in the U.S., I think for Canada, we remain very concerned about a recovery in private investment going forward.
Barry, what about the UK? What do things look like across the Atlantic?
Pretty much the same in the UK from Pedro's comments on Canada. I think the thing that I'd add in the UK that may be a little bit different is that obviously there's part of the attempt to prevent the economic activity falling further and to create a rebound. We're likely to see an increase in government spending on investment. We've got some particularly big infrastructure projects on the go. There's one you may have come across called HS2, which is a sort of railway extension between London and Birmingham, our first and second cities. And that's a sort of multi-billion-pound investment thing. It'll last for a long while as well. And sometimes those big projects tend to cause a little bit of distortion in the statistics as well.
Understood. Understood. Well, thank you both very much. I want to pivot now to just quickly go over the details of our forecast. If we can move on to, there we go, to the next slide. There we are. So as I've mentioned on these webcasts before, the Conference Board is using two different models for making forecasts at the present. On the one hand, we're looking at an industry model, kind of a GDP model, where we're looking at the value that's created across various industries in the U.S. economy. We're doing this on a monthly basis to try to really carve out what the high-frequency impact of COVID-19 is. And that's what we're currently showing on our screen. As you can see, we had a pretty sharp dive in April, which is understandable given the lockdown, and we've been climbing out of it over the subsequent months. Over the summer, as I mentioned a few slides ago, the degree of economic activity has held up better than we had initially thought it would, given the uptick in COVID-19. So we're seeing a bit of a slowdown with respect to maybe May or June in terms of the slope of that black line, but it's still trending positively. That having been said, for the fourth quarter, we're expecting a bit of a lull. And the reason for that is that the initial lockdown and shock of COVID-19 was a supply-side shock that directly impacted businesses. It also resulted in those high unemployment numbers that we touched on just a few moments ago. which of course is impacting things like wages and personal income and consumer confidence. So in the fourth quarter, what we're expecting to see is that sort of demand side anemia really starting to manifest itself in the U.S. economy, and for the level of the recovery, the pace of the recovery to start to slow down. So it's maybe not a sharp W shape, but it's certainly a bit of a lull in the fourth quarter, and then a gradual acceleration as the consumer finds its footing and as the job market improves into 2021. That having been said, we also offer alternative scenarios for this model as well, and that's represented in the orange line. In this line, we're seeing a more rapid improvement. We don't, in this scenario, we think that it's certainly a possibility that the job market continues to accelerate at a faster pace, and that consumers get back into the stores in a more optimistic way than is our base case scenario. So, and this again, this is output. So this is the actual level of the economy as opposed to the growth rates. I want to pivot really quickly once again, just to cover the expenditure side of things. So once we sort of form a narrative and a full model using the industry side, we also take a look at the expenditure side of things as well. I'm not going to go into all the small minutiae here. But in general, we are seeing that kind of improvement. You can see it on the top line numbers in terms of real GDP growth. At present, we believe that we're going to come off that 31.7% contraction that we saw in the second quarter with a 32.9% or so expansion in the third quarter. So this doesn't bring us back to where we were, but it's certainly a lot of progress in the third quarter. But again, in the fourth quarter, once things have somewhat normalized a little bit, we're anticipating a much slower growth rate of about 1% or so. So for the year in total, 2020, we're expecting about a 3.8% year-over-year contraction, followed by an uptick of about 3.2% for 2021. I don't want to spend too much time on this. You can download these slides and feel free to reach out to us as well. We also publish an economy view deck, which summarizes all of this over the next several days. So keep a lookout for that as well. There is one final point that I want to bring up to boot. There's a lot of talk about different shapes for the recovery. Is it going to be a V shape, a W shape, a swoosh, a double dip? There's one that's called the K-shaped recovery. And while this shape doesn't necessarily capture what the economy broadly is doing, it does capture one of the narratives that we are currently seeing, and that's the divergence in terms of the recovery that's associated with demographic groups in the U.S. Our labor market team, led by Gad Lebanon, has done some pretty interesting and important work so far on looking at how different groups in the U.S. are being hit by the pandemic. And what we've seen for the most part is that groups in the services sector are being hit much harder, which include overwhelmingly people who are younger, people who are less educated, and minority groups. And so while the rest of U.S. society may be perhaps benefiting from things like a recovery in the stock market, although perhaps maybe not so much this week, and being able to work remotely from home, which is what some of the data that you're seeing here represent in terms of different demographic groups that are able to work from home, there are elements of the U.S. society that are really struggling right now. And we're going to continue to try to look into this more deeply over the coming weeks and months to give our members a better idea in terms of how the different dimensions and demographic groups of the U.S. society are grappling with this. I want to move on. I've already taken up too much time to Ottoman to talk a little bit about the global economy. Ottoman, go ahead.
Thanks, Eric. So I hope the global economy will set the stage for our upcoming discussion about the UK and Canada. And when we look at the overall global economic output, we see sort of the recovery path unfolding in a very similar way to what you just saw Eric showing us about the U.S. economy. We entered a very sharp contraction at the beginning of the year, and then now we're coming out of that from a very deep hole. And that story is really playing out over and over across many economies. This is a very highly synchronized recession, and the majority of the economies around the world are experiencing that initial supply shock that led to the very large contraction, and then the subsequent, crawling out of that deep hole is really, even though it varies country by country in terms of those quarterly paths, the overall pattern seems to be this very slow, drawn-out recovery path following a very synchronized recession. One interesting fact that I saw was that because this is a globalized shock that's created by the pandemic, there are only 10 countries around the world out of almost 200 where the pandemic didn't reach. They're not affected by it. And those 10 economies are all in the Pacific Ocean. So this is really something that is affecting all economies globally. It's a really rare event. Here in this chart, we're comparing it to the great financial recession that was in 2000 and 2009. The light lines that you see there are for the great financial recession. The darker, the bold lines are for what we are projecting currently. And in comparison, you see how much deeper it is and how the recovery path is more gradual, more drawn out. Emerging markets perhaps are faring better as they did in the great financial recession. But even there's a very gradual recovery, and none of these economies are really coming back to where they were well into in 2021 next year. And mature economies will likely take the full length of the year to get there. So one of the key elements in this outlook is our observation that the supply shock is really transforming into a demand shock because of the pandemic crisis, because of the containment measures that have to be implemented, and the change in consumer psychology, consumer behavior as a result of the concern about the health risks and not wanting to be out there, with other consumers in, restaurants and malls and movie theaters. So that is creating a demand shock, which we see continuing. And we look at our consumer confidence indexes to see how consumers are faring. On a global basis, we have over 65 countries where we track consumers on a quarterly online survey. And there's a great deal of pessimism across global consumers. And there are three factors that really feed into that. They look at their job prospects, their personal finances, and their spending intentions, which come together to tell us of how optimistic or pessimistic consumers are. And on all of those measures, the balance of their opinions suggests that they're more pessimistic. And that pessimism has increased. So the numbers have become more negative from the initial part of the year, Q1 to Q2. Q3 results will be coming out soon, but we're really not expecting a rapid recovery in the level of consumer pessimism. It really depends on, how stringent the containment measures are, how frequently they have to be implemented, how well the labor markets are doing. Job losses are continuing. Temporary unemployment is turning into more permanent unemployment. And the policy responses really vary around the world. And that really feeds into how well the consumers feel about whether they're able to spend or whether they're willing to spend. We've done an exercise that we're showing here in this map graphic where we looked at all those elements and asked our internal experts about how quickly they expect the consumer confidence to recover. The countries that are in the red, we would expect consumers to remain depressed for a sustained period. So many of our mature economies are there. The orange lines, we would expect some recovery. We see Canada and the UK in the orange zone, but that recovery is a slow recovery in terms of consumer optimism. And there's some that might recover more rapidly. We see that playing out in China. The Chinese economy is kind of rebounding, and perhaps that has to do with how drastic their containment measures were. And from our colleagues in our China Center, we're hearing that they've already kind of gone back to normal operations. But I think underlying that is their very heavy use of these tracing apps and monitoring very closely. So varying degree of consumer optimism. So that means that consumers are not spending enough to really put us on a greater trajectory for the global economy. Global trade remains...
Autumn, if I'm going to interrupt you for just 1 second, I think Pedro maybe had some thoughts on some of the consumer confidence numbers that you were just talking about.
Sure.
Yeah, just really quickly, and of course we run the same questions that Conference Board US does in Canada, and I would agree. I think in Canada we have seen a rebound in consumer confidence, but it's kind of stalled. And when we discuss Canada later, I'll tell you a little bit more about how generous our government support programs have been in terms of transfers to households. So incomes have really been supported, and we did see consumer confidence pick up for a while. It stalled just on the news, essentially, about whether these programs were going to be revived and continued. So right now we have a little bit of we have a new finance minister, and there's talk about another program to replace one of the very generous income support programs that was in place. So I do think we may see consumer confidence continue to kind of come up in Canada, but yeah, it's an interesting piece for us because there was concern about future employment, future finances, and we're concerned personally at the Conference Board about how much the support is going to cost us long term, but that's a whole other question.
And there's even talk about this in China as well. We have seen an improvement in the output in China in terms of the recovery, but one of the things that we're seeing struggling is the services sector and consumer spending at retail outlets and things like that. So it doesn't matter what part of the world you're in. I think the consumer is struggling with what's next and their willingness to open up their wallets and purses.
Yeah, no, that's a good point, and that really depends on that consumer sentiment or consumer psychology. Even with reopening the economy, reopening commercial activity, it doesn't necessarily mean that consumers are going to go back to their old habits. They're really thinking about new ways of conducting their commercial activity or using those goods and services, and we hear that from businesses too. They're coming up with new ways to deliver those goods and services. So until we find a new path, we'll be seeing a lot more volatility. So a lot of it really depends on what government policy is doing to cushion the blow and keep that spending level going. Another thing to point out with regards to personal finances, which to some extent are being supported by government policy, is that in this environment, the irony is that pulling back from consumer spending means that consumer savings has increased, but that goes to servicing consumer debts and saving it rather than going back and spending that. So that might be, for the longer term, that might mean that household balance sheets are going to be in a strong position to bring up the spending levels, but we're not quite there yet. That means the overall consumer spending remaining depressed, creating this demand shock for the economy. The overall global trade volumes have come down considerably, and firms not seeing the demand for their production are also pulling back. So on from both sides, consumers are not buying, firms are not producing, so there's much less global trade to go across borders, and we've seen global trade volumes really worsening considerably, paralleling what we saw with the great financial crisis of 2008 and 2009. So overall, this means that we're kind of looking at a world that is less globalized, and maybe these deglobalization trends are going to be continuing. Supply chains are being affected. They're becoming more domestified or onshored, reshored. That means rearranging these supply chains in a different way, and that creates also more disruptions and volatility. Opportunities for the world economy can come from more innovation that is necessitated by the pandemic environment, relying more on digital transformations. That could also give rise to more efficiencies from, working from home and less commute means you have more time for your work. And then new business models can come into being through this acceleration of digital transformation. So a lot really remains unknown, uncertain, and there are risks and new opportunities developing for the global economy. And I think, when we talk about the UK and Canada, we will talk about some of the things that those economies are doing in terms of how their recovery path is shaping up, and what some of those risks and opportunities are. So maybe with that, let's move on to that.
Speaking of Canada and the UK, let's go ahead and pivot here and get our guests talking a bit more. So why don't we start out with Barry and Pedro talking a little bit about what the story for COVID-19 has looked like in Canada and the UK. When did we start to see cases in those countries really start to pick up? When did they peak, and what does the current outbreak look like? Barry, maybe you could take the lead here and just give us a broad overview of what kind of a year you've been having.
Well, January was very good, and then it all went haywire, really. I mean, to be fair, in the UK, our first cases were seen sort of very early, in January and in February, but they were very much sort of singular cases, if you will. I think it's probably fair to say that the UK, the surge in cases in the UK, which you're showing on the blue line on the chart here, really occurred in through March, and the main month really was April. We had sort of two peak days of cases very early in April and actually very early in May, which you can see there. The main probably part of interest for the for everyone listening today is what actions were taken about it, and we had a thing called lockdown on the 23rd of March in the UK. There's a lot of debate about whether that was too late a date. Could it have been a couple of weeks earlier, given what we'd already been seeing in Italy and Spain, where if you'd had those on the chart, they'd pick up earlier and spike earlier than the UK. But we were all sitting at home watching television and then told from tomorrow our job was to stay home. And we had three messages: stay home, protect the NHS, our National Health Service, and save lives. And that whole period was initially expected to last for about 12 weeks. There have been some in that period that would take you to about the end of June. In that period then there was a bit of relaxation towards the end, but schools were closed throughout the country. People only went to work if it was absolutely necessary. Transport was running about probably 10% of normal, things like that, to get people to work. The people who were really doing the work were the health service, the emergency services, and those people who could work from home could work from home. Some shops were open, but with probably limited range of things in them. Since then, we've had a gradual easing in various things, and that sort of mirrors on the chart there the lower number of cases. But as you can see from the blue line there, we just had a bit of a pickup in cases in the UK. Several factors behind that. Probably the fact that, you know, has been traditional holiday time. People have been getting out and about more. Shops and public houses, pubs in the UK have opened up. Restaurants have started to open up, but everything with social distancing. But just yesterday, it was announced late last night that as from Monday, people in the UK couldn't have a meeting of more than 6 people as a part of trying to restrict the interactions of people and restrict the flow of the virus. And some individual places in the UK, three places to name, Leicester, Bolton and Caerphilly, have had actually local lockdowns themselves. So we're moving into a sort of different phase.
Yeah, we're going to talk about the restrictions a little bit in just a moment, but I want to give Pedro an opportunity as well. Pedro, no, not at all. Pedro, what does the case story look like in Canada? Similar to the U.S. or hopefully not quite as bad, I'm sure.
No, well, I mean, obviously Canada's a big country, and we don't have a very dense population, so I think we've lived the benefit of that. There was, I guess, a fear early on because you know, there was a couple of cases that came into Vancouver, our western province, which is very close ties with China in particular. And lots of Chinese residents in BC, and so a lot of transactions happening there. But BC and a very older population in BC. A lot of retirees go out there because it's warm and it doesn't freeze very often. And so there was a lot of concern, but they were very effective essentially at containing the virus and putting in the health measures to contain that in that province. So most of the cases happened a little bit later on, as you see in the chart, in March and April, I would agree. Here in Canada as well, where we were putting in all of the restrictions to contain that. Most of them were in Quebec and Ontario. In fact, the 2 central provinces in Canada, the more populous provinces, account for about 80% of the cases. And I would say, I don't know what proportion, but most of that in the big cities, Montreal and Toronto. We've got all of that kind of under control. We had there's a little spike in cases there, certainly in the last few weeks, where this has been different. Early on, it was really affecting long-term facilities for older Canadians, and that was a disaster. And I would argue that most of the deaths happened there. But right now that problem's behind us, right now it's been more of the reopening of the economy has led to cases among younger Canadians, which is interesting. So the death tolls has stayed low relative to other countries. In fact, even in comparison to the UK, as you can see in the chart, even adjusted per population. Right now, you know, the economy has reopened for the most part. Schools have reopened, but we are starting to see cases coming up in schools. So, for example, in Quebec, they opened early a couple of weeks ago. All the schools opened, and we already had 41 schools or so that had at least one case of COVID. So I think there's going to be a lot of tumultuous times for how the reopening plans progress going forward.
No, thank you, Pedro. We have a slide here where we peel back the onion in terms of some of the government responses that Pedro and Barry talked about. It's something called the Stringency Index, the green line. So the further down it goes, the more stringent the government responses were to COVID-19. And then that's paired with some data from Google, from cell phones that show the amount of mobility that people are engaged in. And you can see that in both countries there's been a pickup in terms of the amount of activity that we're seeing in towns and cities around both countries. But we've talked a fair amount about what the story looks like already, and I'm eager actually to move on and talk about what the economic implications have looked like. You know, where were the British and Canadian economies moving into this pandemic? What kind of a footing were they on? And how bad has the initial shock been? Barry, maybe you could talk a little bit about where things were trending in the UK and how bad it's been so far.
Sure. I think a couple of quick points really. On your left-hand chart, your GDP growth year-over-year change, you can see there that the UK growth rate has gradually sort of eased down from, say, 2.5% in the start of 2015 to nearer 1%. I mean, part of that is that for people who sort of don't know the UK economy, a sort of an average growth rate historically of somewhere around 2.5%, 2 to 2.5% is about the norm. So we've had a period of slower growth, and part of that we believe is due to the Brexit effect and the uncertainty created. The referendum on Brexit was in the middle of 2016, and since then uncertainty about how businesses would cope with the changed environment, whether the vote would go ahead in some ways, and the political uncertainty have probably led to the economy underperforming its trend over that period. And the interesting thing in your second chart, which you show on the right-hand side, is clearly the very sharp fall in UK GDP in the second quarter of this year. If I tend to look at things in quarter-on-quarter non-annualized changes, okay, just so it makes sense. And if you look at the UK, I mean, we had a fall in GDP of 20% there in the second quarter, which was worse than we saw, say, in France or in Italy, which are other countries that have been sort of badly hit by coronavirus and are sort of near neighbours, if you will. But a lot of that fall is due to the deliberate policy to lock down the economy to prevent the transmission of the disease. And if you take the first half of the year as a whole, then our fall is slightly larger than in France and Italy, but it doesn't look so bad. We locked down relatively late. I think there was one of the questions someone raised about, did the UK lockdown relatively late? It probably did, but it's probably a week or 2 weeks. But in terms of a quarter, that can make quite a difference to your figures. So we had probably stronger GDP growth or less of a fall in GDP in the first quarter than some other countries.
Barry, we're going to get a little bit more into what the outlook is in terms of the short-term recovery, but there's a question here about unemployment. As is the case in the U.S., that's been a negative sort of second impact from the lockdown. What kind of unemployment numbers is the UK grappling with at the moment, and what's the trend there in terms of the labor market?
Okay, that's actually a really difficult question to answer for the UK, and let me just explain why. The government's introduced a scheme called the furlough scheme in the UK, where the government will pay 80% of the wages of people who are put on furlough from their employers. And they've been doing that since effectively the start of April, give or take the odd week. And so companies have, if you like, held on to workers where perhaps output was not being produced, and you might have expected ordinarily those workers would be released. So we haven't seen the spike in unemployment that you've seen in the US for that very reason. Of course, the concern is that the furlough scheme, as it's constituted, isn't going to last forever. In fact, the end of this month, the 80% goes down to 70%, and then it goes down to 60%, and end of October it ends. That's the current under current rules. And so the worry we have is that the unemployment rate in the UK, which is still 3.9%, so it's not very different from what it was back in February, will start to could increase quite suddenly. And we have seen certainly in the UK, announcements of redundancies to be made, and these are largely coming from retailers. And one of the big sector that's been hit in the UK, like many other economies, is the service sector, and the retail sector has been particularly badly hit.
What about Canada, Pedro? What was the footing of the Canadian economy walking into this big storm? And the labor market question is an interesting one as well. How bad has the unemployment situation gotten, and what's currently the status of the economy?
Yeah, well, actually, Canada has still a very important energy sector, and what you're seeing in that chart with the 2015 results was, if you might recall, oil prices fell sharply at the end of 2014. That caused a significant recession, 2-year recession in one of our in fact, in all of our energy-producing provinces, but in Alberta in particular, and that's why you're seeing that big decline in GDP growth overall year over year in those 2 years. 2015 to 16 was tough. I would say that Alberta's still been in trouble, and our energy producing provinces have still been in trouble with oil prices not fully recovering. But nonetheless, we have seen the economy doing quite well outside of the resource and energy sector. Canada is a resource and trade-dependent economy, but we have also become a very strong service sector economy. That's what's been generating the strength in labor market growth and good quality jobs in tech, in architectural services, what we call professional, scientific, technical services, as well as financial services. So the unemployment rate was actually really at record low levels in Canada in 2019 on an aggregate basis for the country. We'd seen kind of very strong pay increases in that year to the point where it was concerning, because as you can see, GDP growth was not really that strong, even though employment and wage growth was quite strong. So we were a little concerned about the prospects for long-term competitiveness given that situation. The economic impact that you see in the chart on the right, of course, Canada has essentially gone down about 11.5% in the second quarter. That's at quarterly rates. And right now the economy is essentially operating. We've seen a pickup. If you look at the monthly data, we're operating about 6% below where we were pre-COVID. So I think we have seen the brunt of the impact kind of behind us. We are starting to see an improvement. When we talk about labor markets, I would agree that the labor market stats on labor force participation are all kind of mucked up because of the support programs. Now, our support program has been much more direct from government to households with what we call the Canadian Emergency Response Benefit, which is essentially a payment that is made outside of our regular employment insurance program directly to people, and it's been very effective, very fast at getting on the ground, and very generous, in fact, I would add as well. So the better measure, I think, is employment dropped by about 15–16% at the worst in March and April. Right now, employment is back to about, in fact, in August, about 5.6% below where it was pre-COVID. I think that's the better measure of how deep the impact is. That's about 1 million jobs in Canada, so a huge impact still in terms of getting those jobs back.
Pedro, I want to pivot now, and we just finished talking about how Canada got to where it is now. What kind of an expectation do you have for the Canadian economy in sort of the next 4 to 6 quarters? What kind of a 2021 do you expect? The Conference Board makes its own projections. We are expecting a recovery, but what is your perspective on this?
Yeah, I mean, it's been tough for forecasters in general to first get a handle on how deep this was going to be, and we finally got that, and the numbers in behind us. I think we're all kind of understanding of how sharp this was, and now the concern is how quickly can we get back to normal, and how long that recovery period is, as you pointed out. And I know, in fact, I quite like the Conference Board, U.S. Conference Board's forecast for Canada. We're right now working on our forecast. The national accounts just came out a few days ago, and we're updating the forecast. So I think we will be revising our forecast up, given to something closer to what you have. I would say, somewhere between 4 and 6% is probably where we're going to land up, given the latest numbers on the economy. In June, in July, we're getting a flash estimate for July now from our statistical agency, which tells us we're about 6% below where we were in February of 2020. So a fairly robust pickup. And, you know, we talked about consumer confidence. I talked a lot about this. Let me just finish on this piece, but the support programs have supported income very strongly. This will be the only recession year, certainly, that I've ever seen where household disposable income, that is after tax and after transfers, is actually going to grow at a really strong pace this year. We know that the savings rate, for example, in the second quarter in Canada hit 28%. So there's a lot of, and in fact, spending now, we're on a monthly basis, we're starting to see spending recover to pre-COVID levels. I think a lot of that this is household retail spending. I think a lot of that is pent-up demand. Of course, there's been structural changes as to where people spend, so a lot of pain still for restaurants and some retailers. But overall, we have seen the consumer come back. The question is, given confidence, will we see that hold on through the rest of the year, or are we going to see people really, given what they're telling us in terms of confidence, ease back over the rest of the year?
Yeah, that's what we're concerned about as well for the U.S. for the fourth quarter of this year. But Barry, what's your expectations for the UK? I think the UK situation is even more challenging because you have, number one, the pandemic to take into consideration, but there's also the political question of Brexit and what the potential economic implications of that are. Given that you have two unknowns, what are you currently thinking about the next 12 to 16 months or so?
Well, I think that I suppose there's more than two unknowns in a way, because there's the whole issue of what happens in the global economy itself as well. But looking at the forecasts you have, I mean, we provide a quarterly forecast publication. We did the last one, published it in August, and we had minus 10.1 for the UK and plus 6.1 for next year. So we're very close to you. But one of the things that I was keen to point out was, while 6.1 looks terribly good, I mean, looks a very strong number, that would be one of the strongest year-on-year growth numbers you'd ever see for the UK economy. Of course, if your output's fallen by 10, you need about 12.5% to get back to just where you were. So it doesn't take you anywhere near back to where you were before you started. I would think that there's a reasonable chance that it might take until the end of 2022 or early 2023 for the UK economy to even get back to the level of output it was producing in the end of 2019. And of course, at that stage, you've lost the output also that you might have normally expected to get. I mean, for most economies, you might have a forecast of 2% growth a year that you were getting or something. That's out, you've lost that as well. So overall, there's quite a loss of output in both the UK, but also other economies as well, over and above what I think we were all forecasting, expecting, perhaps hoping for 6-9 months ago. I think the big uncertainty at the moment, as I see it, I talked earlier about the new restrictions coming in, is what the path of new restrictions might be. I mean, in the Northern Hemisphere, we're coming into the winter season. And as Pedro was saying, the latest spike in or increase in COVID-19 cases has been amongst the younger populations rather than the older populations, which were badly affected. But we're coming into a period where we typically start talking about the flu season in the UK, influenza, started to come in, affecting older populations. And if the background is that COVID hasn't gone away, then that adds a very difficult background for, I think, most Northern Hemisphere economies, not just the UK. And in terms of Brexit, well, we're still negotiating with the UK, still negotiating with the EU on the trade transition agreements. That the news on that seems to change from day to day, and they've got, broadly speaking, at the end of October to come up with an agreement that both sides are happy with. Either that, or I suppose if there's no agreement, then the UK moves on to just international trading standards agreement.
Barry, and I want to pick up on that. We're going to skip the next slide, which is about longer-term sort of growth expectations, because I want to maybe talk a little bit more about the global dimension of all this. But before we dig into it, we actually have a second poll question for our audience. If we could bring that poll question up, please. Given the many economic disruptions that Canada and the UK have been grappling with in recent years, things like COVID-19, which we've been talking about, Brexit, which Barry was just discussing, and one thing that we haven't discussed so much, which is the U.S.-Canada trade strife that we saw, especially in 2018, and to a certain extent is picking up again. What are the prospects for stronger UK-Canada economic ties moving forward? Of course, there's been a lot of discussion about a trade agreement between Canada and the UK, and we're curious to see what your perspective is on that agreement. Are you optimistic about it? Are you neutral about it? Or are you pretty pessimistic about it? So let's go ahead and lock that poll up, please. Well, we have some good news. Things seem to be more optimistic than pessimistic. We have optimism accounting for about 53% with regard to that agreement, neutral at 47%, and nobody, and we have over 100 people on right now, are pessimistic about it. So that's some great news. Barry, what are your thoughts on this? UK, Canada trade agreement. What's on the horizon there?
Well, it's always good to go with the majority, isn't it, I think, in things like this. And yeah, I'm relatively optimistic. I mean, in the sense that the UK is actively seeking to make trade agreements. You know, countries like Australia and Canada are natural countries for the UK to have agreements with long trading links. US-US, UK-US is, you know, probably, due respect to Pedro, a bigger deal for the UK than a deal with Canada. But I'm optimistic about that, and I think it's a question of where the incentives lie. I think the incentives on both sides are actually aligned to have a closer trading arrangement.
Pedro, what are your thoughts on the potential for a deal?
Yeah, I would agree. In fact, when we were first hearing about Brexit, I think there was a sense that we could push a free trade agreement with the UK fairly quickly. Our trade relationship with the UK is probably more important on the service side and on foreign affiliate sales than it is on the merchandise trade per se. And most of our exports into the UK are precious metals and gold in particular. So I think it's not really you know, a critical for us in terms of our merchandise trade, but it's more so on the service side and on essentially diplomatic relations. So I would agree that it's optimistic, and we could possibly push something ahead fairly quickly. The other thing I'd say is that Canada has a lot of experience with free trade dealings, whereas the UK doesn't. So I think we could manage the better deal out of this.
You know, one of the interesting things that I came across while preparing for the webcast was this slide here. Canada has had a pretty strong reliance on its export sector for a while, but that's come down in recent years. And I actually was surprised to see that kind of exposure to foreign demand is about on par with what we're seeing in the UK now as well. Just that we only have a few minutes left here. Do either of you, I'm sorry, have any perspective or concerns about how weakness in non-Canadian, non-British markets could potentially impact the ability for these two economies to recover in terms of either exports or reliance on foreign capital, any kind of external exposures that you're watching closely. Pedro, do you want to jump onto that one real quick?
Yeah, real quick. I think obviously our biggest trade partner is the U.S. and very important for our trade. We've had challenges with the U.S. with the current administration with the renegotiation of the NAFTA deal, which is now a new trade deal. But we really haven't seen a lot of growth in exports to the U.S. Outside of energy, there's hardly been any growth at all in terms of merchandise exports. And the same is true with some of our other trade partners. China has been a real challenge for us in recent years. We've had all sorts of trade restrictions on our agri-food products, which had been a sector where we'd hoped to see more growth. So I think that's why you're seeing the numbers kind of trend down here in terms of the share of the economy. Yeah, but still Canada very dependent on our major export markets like the U.S. and China and many others.
Barry, any thoughts from you? In addition to trade, London is also a major financial hub. What kind of concerns have you have currently?
Well, I was going to say, I think the main concern for the UK economy, in terms of international trade more generally, is that 80% of the economy, give or take, is service-based in the UK, and as you say, we have a very big financial sector, a very big international financial sector, and so one of the keys for the UK is that in broader terms, the progress that we've seen under GATT on broadening manufacturing trade globally, we'd clearly like to see more progress made on services more generally in the world and trade there, because that would be very much to our benefit. And I suppose the other key point I'd make is that at a time where we're renegotiating our trading position with our closest neighbours, a bit like Pedro was talking about the closeness of the US for Canada, where it clearly puts an impetus on the UK to actually look more outwardly and to seek improved trade agreements or new trade agreements with other countries as well.
Thank you so much, Barry. We're actually at the top of the hour, so I'm afraid we're going to have to close out and say goodbye. First and foremost, I want to thank Pedro and Barry for coming on, giving us an hour of your time. We've benefited, Audubon and I, from listening, and our audience certainly has as well. So thank you both very much. We appreciate it. For the audience, next month we'll be looking at the impact of COVID-19 on France and Germany. So make sure to set aside an hour of your time to come back. We also are doing quite a bit of work on COVID-19. We have a dedicated page that you can visit at the conference board to look at the most current research that we've been doing. Feel free to log on to some of our excellent podcasts. And finally, we love your feedback. We're always trying to improve the program. So you'll have a slide come up in just a few moments. Please click on it and fill it out. We'll benefit, and it'll make the next episode even better than this one. Thank you again for joining us, and have a great day.
Bye.